In this exercise, we'll be looking at statement of cash flows. Now, this is the fourth financial report that is really important to know. And if you recall back from the exercise on financial reporting, and that was looking at, or financial statements rather, that was looking at income statement and balance sheet and the statement of retained earnings, the statement of cash flows is the fourth financial report that we should know. And as the name suggests, this is a statement where we're looking at the movements in cash flows. So we are basically looking at how does the company generate and tie cash, and what does this mean for the operations of the company in terms of its ability to generate cash, which is of course a vital thing for any business, because without cash, you can't pay your bills. So essentially what we're looking at here is a way of diagnosing the company's ability to generate cash, but also looking at diagnosing, evaluating where does the company tie cash. So that is just to set the scene and say that this is a really important financial statement. And in this exercise, after a brief theory introduction, we'll get in to show how exactly we do it based on the information we're given in this exercise. It is worth noting that there are a few different ways of preparing a statement of cash flows, but the way that you should know how to do it is using what we call the indirect method. And the reason it's called the indirect method is because we're basing it on indirect information, in that we're basing it on two balance sheets and an income statement. So what you'll see when we get further into the exercise and actually setting up a statement of cash flow is that we're basing it on an opening balance or a beginning balance, which in this case would be for 2010, and a closing balance, which would be for 2011. The reason that the ending balance of 2010 is the beginning balance of 2011 is, of course, that the end date of 2010 is the same as the first day of 2011. Also, the income statement is fairly straightforward. You know that from previous exercises where we've looked at income statements, in particular, the exercise on recording financial transactions and financial statements. And this is what we're given here. So you'll see this in action when we get a bit further, but it's worth noting that we need two balance sheets, essentially, one opening balance and a closing balance, and an income statement. So before we jump into actually doing question one, I just want to clarify that when we do a statement of cash flow, we like to organize it into a few different categories. So these categories are the following that I'll just present briefly here. So it's operating activities, which will include, as you'll see, the net income and all current assets, as well as all current liabilities. And again, you'll see this when we get into the question, but for now it's worth noting that we always include the net income under operating activities together with any changes in current assets and changes in current liabilities. The next category is investment activities, where what we're looking at is non-current assets. So unlike in the operating activities where we're using current assets, under investment activities, we're looking at changes in the non-current assets. The final third category is financing activities. And what this includes are non-current liabilities and equity. So essentially, in the financing activities section of the statement of cash flows, we'll be looking at changes in non-current liabilities as well as changes in the equity. So for now, this is just to set the scene. We'll be applying this to the exercise in a few moments when we're done with this brief introduction. So the essential thing to note, which I've said a few times here, is that we're looking at changes in current assets, current liabilities, non-current assets, and non-current liabilities, and equity. So the way to interpret the cash effect of movements in these is really critical to be able to do a statement of cash flows. And therefore, I'll just briefly state how to interpret the cash changes. So cash changes are observed by looking at changes in the above categories from the balance sheet. And more specifically, the way we interpret it is if assets go up, this means that cash, and remember this is what we're looking at here, goes down. So this will be more clear when we get into the exercise again, but this is really worth noting that if assets increase, that's what I mean here, that if assets go up, then cash goes down. The other way around is also true, that if assets go down, then the effect will be that cash goes up. So for now, just make a note of this, but I'll just briefly explain the logic, the intuition behind this. We can imagine assets going up, which I say here is leading to cash going down. Well, one example of assets going up would be if we buy a new machine. How can we buy a new machine in terms of cash? Well, by using cash, right? And that's why cash goes down. Similarly, if we imagine inventory going up, that's another asset, well, then it would mean that we have tied cash in order to build this inventory or to have more inventory. So again, this would be an example of cash going down. If we just apply the same logic here to assets going down, let's imagine that we decrease our assets, for instance, by selling a machine. What would that mean in terms of cash? Well, most likely it would mean that we free up cash, so cash goes up. If we take the inventory example as well, we can imagine that we reduce our inventory, so we shrink it from one level to another. What would that mean in terms of cash? Well, it would mean that we free up cash because we have now sold part of this inventory. So that is the brief version of the intuition and logic behind this. And what is really important is that you remember or at least note these rules, because as you'll see when we get into the exercise in question 1, we're going to be applying these rules again and again. So the other thing we want to look at is what happens to liabilities and equity if they go up. Well, then the cash effect is that cash goes up as well. So note that this is exactly the opposite of assets, where we saw that cash would go down when assets were up. Well, for liabilities and equity, when that increases or goes up, that's why I write it like up here, the effect cash-wise is the same, that is, it goes up. So let's just write this out for the other situation, that is, if it goes down, well, then unsurprisingly, I guess, the effect will be that cash also goes down. So these rules here are quite simple in a way, but really important to remember when you get into the exercise, because we'll be applying them again and again. I just want to say a few words about the logic about the liabilities here, or the intuition, just so that we have that straight, and then we'll move into looking at the actual exercise. So for liabilities and equity, let's imagine a situation where we take out a new loan. That is, we borrow more money at the bank, for instance. That would entail that liabilities go up or they increase. And of course, when we borrow money, more specifically, cash would go up as well. So that is exactly sort of the intuition or the practical implication. We can also imagine another situation where we have suppliers that are giving us credit terms so that we have accounts payable that increase. That would be another example of liabilities going up. Well, in that case, cash would also go up because our creditors are essentially funding or financing our activities. If we consider equity, just to round that off, you can imagine, for instance, that the shareholders of a company contribute capital. Well, that would result in equity going up. And of course, when they contribute capital, leading to equity going up, the result cash-wise is that cash goes up as well. On the other hand, if we look at liabilities and equity going down, we can just imagine the situation of us as a company repaying a loan, for instance. That would lead to liabilities going down or decrease. And the way to decrease a loan, that is, of course, by paying cash. So that is why the effect of liabilities going down is that cash goes down as well. The same for equity. If we imagine, for instance, that we pay out a dividend, that would lead to equity decreasing. Well, how do we pay out an equity? Or how do we pay out dividends, sorry? There are different ways you might argue, and that is true, but usually it will be through a cash dividend, which would result in cash going down. So these were just a few examples. Now that we get into question 1, which we'll see in the next video, we'll apply this to our exercise here, and you'll see how this works in action. So in the next video, we'll get started on question 1.